AI and ChatGPT. It is a buzzword these days, and it reminds me of the crypto days, when crypto was the buzz. AI has actually been around for years. It's just been coming out more from the open source perspective in which people can feed information to AI. And how does that serve the buyer's agency industry? Well, I look at AI and companies no different to companies that were outsourcing, for example, VAs or admin tasks, etc., to other countries or different frameworks of staff. So AI as a tool, to me, and that is a tool, can be used to help the buyer's agency industry in these ways. For example, writing up property presentations, resolving complex formulas or calculations in terms of rental yield, property growth, and cross-verifying information and comparing different suburbs, states, data. But it is just a tool. So here at DDP Property, we encourage all our teammates to use AI, but more importantly as a tool. And ChatGPT itself has a disclaimer on every phrase that it should not be relied on and it can make mistakes. So I think anyone or any company using ChatGPT Assist is great, but if you're going to just copy paste, I think that's where the problem happens. So we definitely use it as DDP to be more efficient, but it requires one to analyze, put your own perspectives in it, and update it. So AI is a great tool. It just shouldn't be used for plagiarism. And there has to be your expert input. And at DDP, we are paid for a service, so we use AI as a tool, but it's definitely our expertise that comes in that is far more important. Commercial or residential property? Well, they're both great investments. It just depends on your risk profile and the type of buyer you are. For example, commercial properties normally attract higher rental yields with longer term tenants in place, that being commercial tenants. However, the downside also is that usually when going for fundings, banks normally require a 30-35% plus deposit compared to a residential property that would require a 10% deposit. So commercial property suits a buyer with that risk profile that is okay to have a higher deposit. And the other part you've got to remember is that if a tenant does leave that commercial premises, what is the time period to find another tenant from a commercial perspective? So in a residential property, usually vacancies rates are so low that you might get a new tenant within 1 or 2 weeks. But in a commercial property, depending on the area, might take a few months. So from a DDP property perspective, we do deal with commercial properties as long as it suits the buyer's profile, and that is what the buyer wants. For example, right now we've got access to commercial properties in Brisbane that average around $480,000, $490,000 with a 6% rental yield. When I look at that in comparison to residential, it is very attractive, especially with Brisbane and a 6% rental yield. But once again, you'll need a higher deposit, and our buyers need to be aware in case you lose a tenant, etc. So it is available. It just depends on the buyer you are, and at DDP, we can help you with both. Is there going to be an Australian property crash happening around the corner? Well, the best way to look at this is history. History has shown over the last 30 years, the average growth in property is approximately 385%. If we average that over the yearly period, that's approximately maybe 5.5% in average property growth year on year in over a 30-year period. But if we look at post-COVID 2020 to 2024, are we seeing significant property rises? Yes, even in my view, it's a bit concerning because I've never seen a market that has risen so far. But we're only looking at a 4-year time period, which is why I spoke about the last 30 years, which is about 5.5%. So when we look at the last 4 years growth post-COVID, it averages approximately 8.5% during that period. 8.5% in over 4 years and 5.5% over the last 30 years. When we put those two in perspective, I don't think, we've not had much significant growth. 8.5 is definitely above the norm, but it's only a 4-year period. What may happen and can happen are adjustments, slowdowns, stability, maybe slight negative drops. But do I think there is a property crash around the corner? No, I don't think so. It's just in the last post-COVID, just like most developed states, we had a massive migration boom into many countries, including Australia, undersupply of houses, a cost of living crisis. All this has pushed property prices up. But if we look at significant events over the last 30 years, we had the mining boom in WA that pushed property prices around 8.5%. We had low interest rates around the 2016-2015 mark that pushed the Sydney, Melbourne property prices around 8.5%. So there has been booms before. no different to what happened recently in the post-COVID boom. So it comes down to, like, for example, using DDP is more about where you're going to be buying, what price point, and what areas and what locations you want to be focusing on. So I don't think there's a property crash around the corner, and history has shown us that. Here's why I wouldn't buy a granny flat or a dual income property. Once again, this is my personal view. At DDP, we source all types of properties, including granny flat dual income properties for buyers that request that. Personally, this is why I've never bought them, built them, etc. Well, you look at two properties, right? For example, you got one property worth $500,000 that's giving you standard rent of, say, $500 a week. Then you've got your next door neighbor property that's available for sale, and let's say it's a dual income or there's a second dwelling there bringing two incomes. But that property may be now selling for $650,000 over, possibly maybe to get an extra $100 in rent. So most don't realize is that they are paying, in that example, a minimum $150,000 in purchase price to purchase the property with a granny flat or a dual income, just to get maybe an extra $100, $150 in rent. I guess my view on this, or my view to challenge this thought process, is why not use the extra $150,000 that you were going to allocate on the other property as a deposit, maybe, to go buy another income property, a normal standard residential property? Because is the extra few $100 or $100 going to really set you financially free? Or maybe had you not purchased that more expensive property just because there's a secondary dwelling, you could have used $50,000, $60,000 and bought another property. And capital growth, thankfully, in the Australian market due to leverage, is based on the full purchase price. So by saving and using that $50,000, $60,000 into another property, you've got now a second dwelling, maybe, for example, for $400,000, appreciating over time. So you've got the first property for $500,000, a single dwelling. You've saved the deposit from, instead of buying a granny flat or dual income, purchased the second property maybe for $400,000, and now you've got $900,000 in total combined value appreciating over time. I feel in the long term, when you look at the combined value of the capital growth, it's going to be far greater than the extra few $100 you get in rent. Why do some of our buyers buy in mining towns? Well, are mining towns risky? We've been told they're high-risk areas because mines might shut down, and then if the mines shut down, you're not going to have anyone there to tenant that property. Growth might go backwards. That is true, but there's risk with everything. We have plenty of buyers at DDP, and once again, that's why we cater for different types of buyers and properties, because it suits a certain type of buyer profile. So we've got buyers that want to pay a cheap purchase price, and I'm talking about properties in regional areas, for example, for $250,000, bringing rents of excess of, say, $500 a week. So that's a $250,000 property with $500 a week in rent. So the yields can be even 10, 11% in return. What's the risk, or what's the catch? Well, the mines could shut down and then you may lose the tenant. But this is what I have seen in these areas. As much as it's an opinion the mines have shut down, I look at some of the areas in Queensland, in Gladstone, Rockhampton, back about 15 years ago, when people got into those mining areas, and then they sold out because there was changes in mining demand and supply based on Australian mining companies and overseas demand. And people then freaked out and sold those properties. And now I look at Rockhampton and Gladstone, property prices have been significant in those areas, which comes down to my fundamental principle that property is a long-term, minimum 10-year hold. Had you held that asset for the long-term hold, the people, in my view, would have regretted selling those properties along the Queensland coast in Rockhampton, Gladstone. So once again, we at DDP have buyers that buy properties for $250,000 with rent of $500 a week. And some of our buyers are even cash buyers because they'd rather maybe the money sitting in their savings account or their self-managed super fund or superannuation account want to attract 10% returns rather than that fund sitting in the bank, and they go and buy these mining properties. Or it might even suit a different type of buyer rather than, that I explained in another video, rather than buy a very expensive dual income or granny flat type of property, would rather break down the purchase price and split it into a few cheaper properties in these mining town areas to attract higher rent. But the other part I've noticed, even with coal mining, I know there's a lot of against, coal mining and mines shutting down. But coal is still in demand, and there is continuously movement in the coal mining area. And the other areas that I've noticed when I look at mining towns is some of these mines that are being converted or shut down, they're actually being converted into renewable energy type of mining, so that the area is changing and the demand for that type of product or service is changing. So I definitely wouldn't say no to mining town. It comes down to your profile, your risk profile, and that's what at DDP we do, is we strategize a solution that meets your criteria.